In this episode, we discuss the critical role community banks play in housing and construction lending with the ICBA. Discover the importance of tailored regulations to their survival and how reducing unnecessary burdens can enable these banks to better serve their communities. We also explore the future of housing and the growing need to foster innovation in lending.
In an ideal world, if we can sort of unwind some of these regulatory challenges that are burdensome, that are costly, and push many small financial institutions out of the mortgage space, that could be beneficial not to just community banks, but to customers that want to buy their first home, want to, participate in the American dream of home ownership.
It gets down to sort of tailoring regulation based on the size of institution, as well as the risk that institution poses to the system.
I'd like to welcome everybody to the Construction Lending Podcast. I'm your host, Sean Ferris with Langrill, and today we welcome Tim Roy, Vice President of Housing Finance Policy at the Independent Community Bankers of America, or ICBA as we know it. Tim's focus is on the critical regulatory and legislative issues that impact community banks. He's deeply immersed in the workings of Fannie Mae, Freddie Mac, the Federal Home Loan Bank, and the CFPB's mortgage rulemaking. As the staff liaison for ICBA's Housing Finance Subcommittee, he's on the forefront of policy discussions. Tim's unique background gives him a powerful perspective on the evolution and future of housing finance. Along with Tim, we also have Ron Haynie. Ron, this is your second time on the podcast.
Yes,
and Ron is Senior Vice President of Mortgage Finance Policy, joining the conversation. And Ron brings over 40 years of deep industry experience to the table, having navigated the complexities of mortgage lending and secondary markets at Freddie Mac. And he then transitioned to champion the needs of community banks. He's a leading voice on the critical legislative and regulatory issues that shape mortgage finance, from GSE reform to CFPB rulemaking, making him an invaluable resource for understanding today's market. Now at the ICBA, he's on the forefront of the regulatory challenges and landscapes, providing vital guidance on everything from federal home loan banks to the intricacies of the CFPB's regulations. Gentlemen, after a mouthful, welcome to the show. Ron, welcome twice.
Thank you. Great to be here. Thanks for the opportunity.
Thanks, Sean. Great to be here.
Why don't we just kick this off, and maybe Ron, you could give us a general explanation of the ICBA's mission and what your initiatives are this year.
Well, ICBA, we represent community banks. Our mission statement really is that we work to create an environment where community banks flourish, and so that means they're growing, they're serving their communities. There's roughly, 16 million people and roughly 1 in 3 U.S. counties, need to have a community bank there, because without them, there would be no presence, no financial institution presence. So, it's an important role, and community banks, they're just like the lifeblood of local communities. They make the majority of small business loans, and that fuel small businesses, and agricultural loans, small commercial. And even some consumer lending, as well as mortgage lending. So they're also vital to the construction lending industry. In small towns, they're the source that provides the financing that builds homes. So it's a very important group, very important industry segment, and it's rewarding to see what they do, and whether it's helping build the new local hospital, or the new housing development, or in times of natural disasters, they roll up their sleeves and they're out there, taking care of their neighbors and helping rebuild communities. And so it's a pretty broad and rewarding industry. And so really honored to be a part of it, and the people that work in it. I don't know, Tim, anything there you want to add or not?
No, I think you covered it great. Community banks they're in the trenches with their communities, and if their communities thrive, they thrive as well. So it's a good arrangement, and they're, of course, critical And I mean, just to go back a few years during PPP, that's evidence in itself how critical community banks are for their communities and small businesses.
I definitely agree. Community banks serve this amazing purpose for their communities, and I think the PPP thing, fantastic example. As you guys are looking out now, what are some of the current policies or trends that you see out there affecting or impacting community banks?
Well, I'll start it off, and then maybe Tim, you can jump in. Obviously, regulatory landscape is challenging. One of the one of the things that we are dealing with, obviously, was that through the last couple of years, there was over 5,000 pages of regulations written, and just start to think about that. How do you
5,000 new pages or
5,000 pages of rules, right?
wow.
And it's not like reading a really nice novel that you're really into. If you've ever had the opportunity to read a regulation from a regulator, you'll find it's written in a language that's very difficult to understand. And so, you think about that, and how do you comply with all that? And community banks are not big institutions. They don't have there's not a lot of staff. People wear multiple hats. Our average member probably has in fact, I know under 100 employees, our average member does. And even some of our larger community bank members, don't have the thousands of employees that some of the largest institutions have. And so it's difficult for them to comply with this. One, you got to read everything. Secondly, you have to understand the impact on your institution. And then what changes do you have to make? What do you have to do differently now? How do you have to report that? Do you have the systems to collect that data and report it in a format that's suitable? And it's not like you can just send in information, right? It's got to be in a certain format. It's got to be done a certain way. And that's all. And if you don't, there's consequences. There's fines, there's consent orders, there's lots of things, and none of them are good that happen. And so it's a very, very difficult thing. So again, think about that. 5,000 pages of regulation, new regulations. This is on top of everything else that's already out there. And so, it's a challenge. And one of ICBA's main drivers going forward here this year with the new administration is we have a program that is called Repair, Reform, and Thrive, where we identify certain regulations that are out there that need to be either fixed, completely reformed, possibly if we can get it rolled back, that would be great, to try to help community banks to move forward and thrive. And that's what it's all about. So it's a daunting task, but that's what ICBA does. So I don't know, Tim, on the housing side, what do you think on that?
Well, I mean, with housing is like one of the prime examples of regulation that has sort of snowballed over the last, decade plus since Dodd-Frank, and especially over the last few years. And community banks are finding it more and more challenging to stay active in the mortgage space. It's challenging to, issue a mortgage loan for a customer and deal with the regulatory landscape. And, what community banks do, what they're best at is tailoring loans for their customers. And if they can't do it for the customer, and often their customer may not have another option, community banks are very often their only financial option for many of these customers, especially in rural communities. So if in an ideal world, if we can sort of unwind some of these regulatory challenges that are burdensome, that are costly, and have pushed many small financial institutions out of the mortgage space, that could be beneficial not to just community banks, but to customers that want to buy their first home, want to participate in the American dream of home ownership. Probably the best way to, garner wealth for third generation and future generations. So I think if we can do that, I think that will go a long way. And I mean, of course, there are other challenges, and those are like the housing shortage, the cost of housing in general and supplies and all that. But if we can chip away at the regulatory burdens, then I think this that's only a good thing.
I definitely see how regulation disproportionately impacts community banks. Just resource wise, head count. You don't have 80,000 people in your organization and a whole building, dedicated with attorneys and people to read those 5,000 pages, right? How do we fix that? Right? You said rolling back some regulation, eliminating it. Could you give us like an example of what you would roll back or what you would eliminate?
Well, I think the whole notion is, and we've been raising this with regulators for a long time, and it gets down to sort of tailoring regulation based on the size of institution as well as the risk that that institution poses to the system, and so that automatically maybe would speak to, while if you're a big huge national, one of the big mega banks or whatever, and you're in all kinds of different lines of businesses and you're global and everything else, the risk profile of that institution is completely different than the risk profile of a local institution that might have maybe two branches in a single county, or two little towns, right? And so, the amount of burden, like whether it's reporting, collecting of data, HMDA data is a really good example. Community banks lend in their communities. That's the only place they can lend, right? They're not lending, nationwide. They're lending right there, at home. And yet, the amount of data that you have to collect for HMDA reporting is pretty substantial, and it was increased through Dodd-Frank, and the CFPB, obviously promulgated a rule on that. We were able to get some of that rolled back. During the 2018, where we had that regulatory relief bill, S-2155, but consumer groups or whatever, some of them sued the CFPB, and that rule got overturned, and so some of our smallest lenders have to complete the same amount of information and report the same amount of information on mortgage loans that, say, Wells Fargo does. And again, these are small institutions. There's one person probably that handles that, along with about 5 other things or 20 other things. So it's very difficult. And not saying that that community banks don't want to lend in their community. Again, that's where they lend. There's no other place for them to lend. They have to meet the needs of their community, so they go out of business. It's very simple. And so I think HMDA is a good one. Even CRA now, recently the banking agencies have pulled back on that, and have indicated they're going to look at reproposing that rule. But the CRA rule that was put together by all the banking agencies, it was, in response to, it needed to be modernized, but it kind of went way overboard. And again, you have smaller institutions having to do the same level of work and compliance work that our largest institutions have to do. And the two things just don't add up. And so it makes it very difficult for people to comply with. And again, if you don't comply with a regulation, bad things happen. You get written up, you get consent orders, you get fined, all these things. And so it's very difficult. And so what happens is, a lot of times, unfortunately, depending on what that particular regulation is, institutions, small community banks will sit there and say, well, we'll just get out of that line of business. We'll only focus on this. And so in that sense, community loses down the road.
Yeah, just think about missed opportunities. Community banks play this huge vital role, but this regulation may prevent a bank from getting into something, offering a certain type of farm loan or community loan or making a construction loan, simply because the regulation is really tailored for a massive organization, not a a smaller community.
Mhm.
Um, And as you were talking there, Ron, I keep coming back to this question of how did we get here? And we hear a lot of discussion about regulation and what's going on in our government today. But how did the community banking system get to be the tale of two banks, big and small? It seems like our community banks are almost being strangled. The way you talk about it, it's almost being strangled to do the service they want to provide for their communities, and it's not necessarily the community banks that are causing some of the issues, right?
Right.
How did we
Yeah.
get here?
Regulation, it all kind of tends to roll downhill. So, yeah, and that's the thing. I mean, obviously, after the financial crisis, and now almost 20 years ago, you've got Dodd-Frank was a very big. It changed a lot, and anytime there's a big, huge financial event that happens, Congress usually reacts, and generally maybe not the way that we would want them to, but they'll generally react at that point, and that's what happened with Dodd-Frank. And I'm not saying there weren't things that needed to be addressed, but the thing of it is that it's always says, well, we're going to make sure this never happens again, and okay, let's make sure that the bad things that happen don't happen again. And I think actually that's actually gotten accomplished. You've got the qualified mortgage rule. You've got TRID that that refined the TILA RESPA disclosures, and the rules around that. Even some in the mortgage servicing rules. All those things actually, I think, did help. I think strengthen the industry to the extent that borrowers, knew what was going to happen. They understood the loans that they were getting. Some of the bad features, such as the negative amortization or the liar loans, where there were no income, no asset loans, those are gone. Loans have to be underwritten. All those things, which is kind of common sense, but obviously things got out of hand during that period in the run up to the financial crisis. And I think that's it. I mean, it's sort of this. The pendulum always, it never goes back to the middle. It's going to go one way or the other, right? And I think that's what happened. But a lot of the rules come with a lot of reporting, and the government wants data, and then you've got to check to make sure the data is correct. And so, yeah, that's where it gets to be expensive. And so that's where you're like, I need to hire 5 people or whatever to just do this report. Now, these people aren't going to be producing anything. They're not making any loans. They're not collecting any loans, but they're going to have to make sure that we've got this data, or we're collecting this data on loans that we make, and then we're sending it to these different government agencies, and it has to be right. And that's the burden. That's the burden. It's like it's not like, oh well, they just need to send us that information. It's not that simple. So that's how we got here. I mean, it really is. And you got, if you look at really the largest financial institutions, they've all grown. They've all gotten even bigger since Dodd-Frank. And while you've had the number of community banks that have actually declined, because it's an expensive business and it's difficult to stay in business when you've got that compliance burden. So I think that's sort of the key point. I don't know, Tim, if
I mean, and I think that's right. And I think combined with that, or parallel to that, we've seen the proliferation of non-banks taking over the mortgage space. Non-banks, which are subject to much less regulation, much less oversight. And we see like the Rocket mortgages, which are behemoths. And, I think that down the line could become a problem if things go south. But I'd also add, somewhat related, is that since the financial crisis, since Dodd-Frank, over the last few years, especially, the quality of loans are so much better. Like the book of business is like pristine in comparison. And so I think that is an additional outcome of the last few years of regulation, or since in the years following Dodd-Frank, and as banks have adjusted to the new regulatory regime, loans are so much better. We're not back to the bad old days.
What would you keep and what would you get rid of then, Tim? That's the loaded question right there.
That's a very loaded question. I think that to an extent, like Ron brought up TRID, a lot of it's still a challenge. It's still costly, but a lot of banks have made that investment to, adhere to the TRID requirements. And, I can't speak broadly, but like to unwind that might become a burden actually if we got rid of it. So, there are parts that are already baked into the banks and their lending and mortgage and in the mortgage space. So to the extent that banks have already adjusted or already accepted they TRID as a necessary burden, so to speak, that those can stay, or they're not perfect, but that's one example. But yeah, I don't know. In terms of what I will say that nothing is perfect. And so I think to the extent that we can modify and improve some of the challenging regulations, that might be preferable to as opposed to deleting them altogether. I don't know, Ron may disagree, but
No, I think you're right. I think HMDA is one. I think HMDA, some of the really small institutions that have to do that reporting, it doesn't make a lot of sense. And again, it deters them from doing mortgage lending. I think that's clearly one where they could raise the threshold on that. And that's actually part of our proposals to the regulators and the Congress to try to change some of those thresholds that were put in place now almost 20 years ago. Some actually even further back than that, and update those thresholds to where it makes sense given today's size of their institutions. I think there's just this whole notion of it's not just one reg, right? It's one on top of another, on top of another, on top of another, right? And to Tim's point about the competition from the non-bank sector has really increased, and gosh, now even add in a lot of the fintechs, right? Mm-hmm. And how that all goes and competes against community bank, and it's mortgage lending is one thing that community banks may do. It's not the only thing they do, right? And so it's like, okay, there's competition for resources there. So, how do you make it better? I think, making it easier for community banks to get into the mortgage business. You get the licensing, the registration through the SAFE Act. Not saying that's a huge burden, but it's a cost. Banks got to get registered, and then so do your loan officers. And yet, the stuff that the loan officers have to do is no different than what they've always done. Banks have always done background checks on loan officers and employees. And on top of that, they have to train them. There's a minimum required training. And so on top of that, you've got to do all the reporting, and then you've got to pay to do the reporting. And so, it's those are the types of things that, that add up over time. Servicing rules. The servicing rules, I think, one of the things we've advocated for a long time is raising the minimum threshold for the small servicer exemption. And a lot of people may not know about this, but there's a small servicer exemption, and so if you're servicing under, I think it's 5,000 loans, you're exempt from some of the statement, the types of statements that you have to send, as well as the loss mitigation waterfalls. You're able to utilize your own policies and procedures. That's something ICBA did. Nobody else did that. That was ICBA doing that, and got that done during the early days of the CFPB and implementing the Dodd-Frank rules. But that threshold is old, and so it needs to be raised. And a lot of community banks, if you look around the country, it's difficult for them to service loans for others. It's very difficult for them to do that because of the cost that goes with it. So, how do you make that, maybe if you raise that threshold, it makes it more affordable.
Here's an interesting way to kind of think about this and think about the impact of regulation and um, what happens if we just snap our fingers right now and everything gets rolled back that you want rolled back and all the changes magically happen. How does that landscape look different for community banks? What is paint me a picture of what happens.
That's a good one. Um, I don't know. Let me think here. I think for starters, I think what you would see, and then this also goes to, we were kind of talking earlier about not a lot of, there haven't been a lot of new banks chartered, just a dearth of new de novo community banks. I think what you would see is that you would see that local investment come together and form new banks and form new community banks. And then that would also increase that level of service in those communities. And so I think you see those communities start to thrive more. More would get back into mortgage business, depending on what the regs were, or whatever. And, they would get back into mortgage business and take back some of that market share that they've lost to non-banks. It kind of runs the whole gamut. I mean, one of the big reasons why a lot of the mortgage servicing in many ways has gone away from community banks and banks in general. It has to do with the capital rules for holding MSRs on their balance sheet. Okay. And that was done through Basel. It had nothing to do with, well, I guess it had something to do with the financial crisis, but really that whole thing was going along on a separate path. But, it had nothing to do, with, I don't think, with the financial crisis. Really, what ended up causing the problems, it wasn't mortgage servicing rights that caused the problem on bank balance sheets. And so, so things like that, if you could change that, make it so that it's not punitive for a bank to hold mortgage servicing rights, then they would do it. It's a good asset for community banks. It's a natural hedge, actually, in many, many ways, if you're a decent sized mortgage lender. And the community bank business model is one of relationship lending. So they don't want to sell the servicing. They want you to come to the bank and make your payment, or make your payment through their app, in their bank. And so, and if you run into problems, you go into the bank and work out a solution. Not, you don't have to pick up the phone or try to talk to somebody thousands of miles away. I don't know, Timmy, anything that you would think?
I think just maybe more generally, and we talked about this earlier as well, is I don't think community banks would have to start picking and choosing which lines of business they want to deal with. They wouldn't have to say, okay, we're only doing small business, but we don't want to do mortgage loans because of the regulatory challenges. They could say, we can do small business and mortgage loans. We can deal with the needs of all our customers, as opposed to maybe having to say no or refer them somewhere else. And I think what makes community banks so great is how versatile they are, how versatile they can be, and how flexible they can be for their customers in tailoring these loans. So if they can be involved in all the lines of business that their customers come to them with, then I think that's just gonna, it's gonna expand their business for one, and it's gonna help their communities. And it'll also mean they'll be it's a common term to use, but on a level playing field with all the non-banks, the credit unions, and everyone, and the other institutions that aren't subject to the same regulatory challenges small banks are in today's environment. I think it would be a great ideal world that we're envisioning.
Yes. It seems like there's such a drastic difference in pictures, regulation, non-regulation. It's way oversimplifying it, but do you ever feel that, some of this is, when you look back last 20 years, even last 30 years, do you ever feel that some of the regulation is out of design to hurt community banks, to eliminate community banks, to change the landscape? You think about too big to fail. That really doesn't mean what it means. It means bigger banks get bigger, right? Do we ever feel that some of this is intentionally designed to eliminate community banking?
I I mean, Ron, I don't think so. I think if you ask anyone in Washington what they think of community banks, they're gonna say we love them. I mean, there's no doubt about that. I don't think that
Actions are way different than those
it's
words. We
true.
all love community banks, but we sure love to pile up regulation on them.
It's true, and I think, and like Ron said, like they regulation that's intended to target large institutions. That's all well and good, but the regulation rolls downhill. It sets the tone for the regulators, and I think that has ultimately brought in regulation that wasn't intended for small banks. It's affected them that way. I wouldn't say it was intentionally designed to do so, but I mean, there are some folks who would say maybe we don't need 4,000 lending institutions in the country. Community banks make up the most of that, but community banks, we do need that many. We need more.
Yeah.
In fact, so I don't think that's a good argument. But I don't know, Ron. What would you say to the?
I mean, I think that's it. I don't think they were designed with the intent that to put community banks out of business. I think again, regulations, rules, or let's start back with statute, right? With legislation designed by people that generally don't know the banking business, right? They just know there's something that went wrong, and they've got to try to find a way to fix it, right? And so, they pass, a law. So say it's Dodd-Frank or whatever it was. But I mean, you can go all the way back. You can go back to truth in lending. You can go back to ECOA. You can go back to all of these, the original CRA, all these. And, I guess I've been around long enough to remember all those. And, they were all trying to fix something that was wrong. They were trying to fix something and try to make something better. Something that, we wouldn't go through this, whatever that was again. And so I think, that was always the intent, but, what they didn't understand was sort of the impact on that. And again, if you're one of the mega banks, you just throw other people at it, and it's just the cost of doing business. If you're a community bank and, you've got, 30 employees, which one is going to handle all the compliance, right? And it's difficult. It's a whole different world. But yet, for the majority of rules that are out there, a small community bank has to do the same thing as the biggest players out there. And so that's the problem. And the regulators don't seem to understand that. That's what we spend a lot of our time doing, explaining that to them. And every once in a while you get an aha moment, like, oh yeah, we didn't really think about that. And but that's it. I don't think it's intentional, but I think it is something that happens, and that's why we push for tailored regulation, and and again, based on business model, based on the risk of the institution, things of those nature. So we're optimistic. We're very optimistic that that at least right now people seem to be listening to that notion. So we're gonna keep working that.
How do you feel things are going right now? I've been to a couple conferences this year, and it's kind of been a mixed bag. I sit in on a lot of calls. The one that's just blowing my mind right now is the number of conversations we have with community banks where had it happened twice in 1 week, where they say they've taken more construction loan applications this month than they did the entire last year. And I just hear that and I go, and it's very market driven. And I'm like thinking, wow, that's pretty profound.
Yeah.
How do you feel things are going for community banks? You got some that are saying, hey, this is great. Some are saying interest rates are still a little too high. Some are saying, hey, it's very promising. Like, what are you seeing out there right now?
Well, I actually had a couple of conversations with some bankers, even as recent as last night. But what we're seeing is that actually business is actually pretty good, especially in the construction business.
Mhm.
And but even in commercial and small business lending, it's pretty good. And in the mortgage world, that I'm hearing from bankers that their production's up over last year, and I think it's a combination things. I think people, number one, people got to move. People have to have houses, and especially on the construction side. I mean, here's the thing, at least with if you're doing a construction loan and building your own house, you can build something that you can afford, right? I mean, I think that's important. If all the housing stock that's out there is so inflated or whatever, then build your own if you find a piece of ground, et cetera, and all that. But I mean, that isn't a viable alternative. And again, that's what community banks do. They do that business. I don't know, Tim. What have you heard from the housing committee?
I think business is good. Like I had a meeting with them last week, and they have no huge complaints right now, which is odd. But I mean, from them, they are saying the cost of housing, the housing supply is the biggest challenge right now, along with non-bank competition. Um, but yeah, with construction loans, I think construction lending is the bread and butter for many community banks, and it's not surprising to me that that's up given the cost of the existing housing stock right now. And and I think there is a sense of optimism with the group that things are on the upswing, that they are excited to go forward with many of these construction loans and helping their customers find new ways to uh, achieve home ownership. And construction lending is a great avenue for that.
Where we see, just really interesting conversations is about, what does typical look like, as everybody
Mhm.
tries to factor in this, locked in. I heard locked in place as a term, meaning, hey, I've got a 2.25% interest rate, and for me to go buy the exact same home that we're living in today, my monthly payment will be 3.5 times what it is today because that house is appreciated. My house is appreciated so much, right? Is part of the factor. But then, today's current interest rate plays a big factor in that. And we think about, at any given time in history, what is the ratio of new homes that have never been lived in compared to existing homes? So options for people to purchase. Am I buying an existing home, which is historically made up 90+% of the inventory versus the 5% new construction that's coming into the market as new inventory? Well, that big chunky 95% is scrunched to nothing. So what is the conversation around, well, what does the future look like? How much will new construction play into that? And just really kind of love to hear your thoughts on what you guys are hearing, how people are preparing for this. um, what kind of role do you see community banks playing in all this?
Mhm. Yeah, go ahead.
Oh gosh, yeah. I think that it's hard to predict the future right now. Obviously, the new administration, and don't want to talk too much about the impact of tariffs and the like on construction lending and the costs of housing. But yeah, I think community banks are so. I think they more than many people probably think community banks are very in tune with their customers and the housing market in general, and they are often on the forefront of these things. And they, if there's anything they know how to do, is you know be creative with lending products and construction in the construction space. There's lots of ways to do that,
Mhm.
and I think community banks, like they have always done, will continue to be among the lenders out there that will provide these products to their customers. And I don't see
Mhm.
that changing.
Yeah. I mean, I agree with that. I think the thing about one of the beauties of the community bank business model is the fact that they can be flexible, and they do act, and they reflect what's going on in their particular community. So, like the bankers I talked with here recently, it's like, what's going on around here in the Treasure Valley in Idaho, Southwest Idaho, and and the area's growing. It's growing like crazy, and there's not many houses for sale. Look at my neighborhood here. There's a couple. I mean, one just they go up and they sell pretty quickly. Um, but um, but they're building. There's a lot of building going on, and are there concerns about, okay, well, what's the impact of tariffs or whatever? And yeah, there's concerns, but no one's really seen the impact yet. I think a lot of builders, in the lead up to the new administration taking over, they were planning just like anybody plans for their business, right? Well, okay, well, maybe we better buy some more lumber, or what, maybe we better stockpile certain things or whatever. And I think there's some of that that's happened. I mean, we'll see how this all plays out. Nobody really knows, but I mean, community banks are versatile, and ICE allows them to do that. They can be very, very creative, and so I think it's positive. One thing I said to Tim the other day was that, actually, how do we solve this housing crisis? Well, I think you need folks of my generation to give up their houses. And I said, but to your point, it's like, why would I do that? I could go down the street here and buy something that's like half the size of my house, right? But I'm going to pay a heck of a lot more for it. So why am I going to do that? I'm not. So, you just got to wait for us to, I guess, go off to the nursing home or something. But anyway, it just, it will happen. I mean, people do move, and they have to move. Things happen in their life. They have to make changes, and that will happen. And, I think the baby boom generation, as that, we kind of go off into the sunset here. I mean, I think that is something that will happen. Now, how fast it happens, who knows, but I think that will help. And I think, we do. I mean, we just need to build houses. We definitely need to build some houses. And so that's where, community banks have a role to play.
No, love it. Absolutely love it. And on that note, the last part of the podcast, Ron, I think you participated in this last time. We do a little rapid fire. Now, Tim may throw a couple extra questions your way because, I already know some of Ron's answers. But if you're ready, I've got the first one coming at you.
All right, hit me.
Have you ever built your own home? Is part one of the question.
Have not.
Okay. Would you ever build your own home?
With my own hands?
Well, not with your own hands. If you can get construction financing, would you ever entertain the idea of building your home versus buying an existing home?
Absolutely.
Why?
I think, I think it's like the micromanager part of me, likes to be in control of like what's probably going to be my home for 20 years, hopefully. I like to be in control. I guess it's maybe to be in control and being able to live in a property that fits my own personality and needs.
Okay. All right, question number 2, because that was technically question number 1 in a couple different parts, but question number 2: if you could snap your fingers right now and remove any piece of regulation, which one would it be?
Oh my gosh. This might be controversial. I can't elaborate, but I would probably say 1071.
1071, which is, for those that don't know, 1071.
Which is it's like HMDA, but for small businesses or commercial loans.
Commercial HMDA reporting requirements is kind of it in a nutshell.
Yes.
Without diving in, and that has some pretty big implications if you were able to just snap your fingers and things all of a sudden get a lot better and easier.
It does, yes. So it like with mortgage loans, those are relatively cookie cutter. compared to commercial loans, there's not a single one that's the same. And to have to report the same data on each of those is going to be incredibly burdensome for.
It's got to be a nightmare. Got to be a nightmare. Mm-hmm. That one, you need a good AI model to just sit there and say, hey, we're going to just drag and drop the information in, and out spits, wow, there's our reporting. Hallelujah. All done.
Yeah.
Both of you, thank you so much for being on the podcast. Really just a wealth of information, and just learned so much today about the ICBA and what you guys are doing. But I can't thank you enough for being on here, and I'd love to have you guys back sometime soon. If people that listen to the podcast today wanted to get a hold of you, what's the best way for them to get a hold of you, Tim?
You can find me on, well, of course, LinkedIn. You can find me on ICBA's website. That'll have all my contact information and email address and all that good stuff.
Yeah. What about you, Ron?
Same thing. Same thing. Yep. All of our ICBA, all you got to do is go on our website. You can come up with our staff, and there we are. So we don't hide.
Fantastic. Well, thank you both again for being on the podcast. I really appreciate it, and hope to have you on back soon.
Sounds great. Thanks a lot.
Sean.
Take care, Sean.
This podcast is intended for educational and informational purposes only and does not replace independent professional judgment. Land Gorilla Inc. makes no representations, warranties, or promises for and disclaims any express or implied warranties related to content. Before acting on any information, you should consider the appropriateness of the information as it pertains to your unique business needs.